I'm Luis. I'm with ACRA Lending. We are a non-QM lender. We specialize in DSCR and bank statement loans. And I'm here just kind of chat about the non-QM world with you guys. It's a pleasure being a part of your team.
Thank you for joining us. So, Luis, how long have you been in the business?
So I've been in the business just about a year now. So I just came up on my 1 year anniversary recently, and it's been a whole new transition for me into a new industry, and it's been an awesome time to learn and dive in and learn some guidelines, learn the industry, and I've had the pleasure of meeting a lot of brokers like you guys and learning from you guys as well. So it's been pretty cool. But yeah, I've only been in for about a year now, and I've dove headfirst into the non-QM space, and I've learned a lot about it along the way. It's been pretty cool.
What I loved about Luis is that he gets into it. If he doesn't know an answer, he'll get back to you within X amount of hours, and then he has an answer. So that's the beauty. So, Luis, you want to talk a little bit about what does the typical ACRA lending client look like, and how do they differ from your traditional Fannie and Freddie borrowers?
So yeah, definitely. When it comes to our what a non-QM client is going to look like opposed to your traditional clients, you're going to get into an array of things, right? We do a lot of self-employed borrowers, right? Self-employed borrowers have a harder time finding traditional financing when it comes to having their own job. There's different requirements when it comes to how long they need to be in that profession or that job before they can qualify for traditional lending. So on the non-QM side, there's room for like if you've only been self-employed for 1 year versus if you had to be in the business for 2 or 3. So you get that side of things, and then you also get the investment side. So we do a lot of DSCR loans where you can purchase an investment property, and you're doing it based on what that property's rent is going to bring in, opposed to what you qualify for on your own. And then we also have the other side of things where it's people that would traditionally go full doc, but they either have a bankruptcy on their credit that isn't seasoned enough, or they have mortgage lates that aren't seasoned. Situations like that, very case by case. They had to go through a short sale or a quick claim deed. So situations that are unique to credit events as well. But our bulk of our clients are self-employed or people that are looking to buy investment properties. And then we also find a path forward for ones that are struggling with credit events as well.
Okay. Well, with that, let's talk about that self-employed and bank statement programs. Many agents work with self-employed buyers. So how do ACRA's bank statement or P&L programs make it easier for them?
So yeah, so when it comes to traditional bank statement loans, you can do 12 month or 24 months of verification based on those bank statements. And the lender, like myself at ACRA, will take those bank statements and will tell you what you qualify for income wise. And traditionally, we'll do 50% of that business income and then put that towards what you can apply, like what you can afford. But then we also allow up to 90% if you can get a tax preparer to say your business is, you have a cleaning business that you have to buy cleaning supplies, but you don't have a lot of overhead. So for all the self-employed borrowers that don't have a lot of overhead, we can support up to 90% of those of their income as long as a CPA or a tax preparer is willing to tell us so, which is a nice little caveat. And then we also have P&L programs, 1099 only programs, and written verification of employment programs as well to support in our bank statement world. So you have borrowers that can benefit from their CPA preparing a tax preparer letter of what their profit and loss looks like, and then we take that and we analyze it and then give them their qualifying income. One of the cool parts of our P&L program is if they have good FICO, 700 plus, and they're bringing 30% down on their property, we don't need any bank statements to even verify that P&L. So a lot of people can kind of get through it without needing to show that P&L matches their bank statements as well. But it's a nice way for self-employed borrowers to have a path forward because a lot of times they're writing off money and they don't qualify traditionally. So we'll look at the money entirely in their bank account, what comes in, what goes out, see where those deposits are coming from, what their expenses are going towards, and then we'll calculate it accordingly to allow them to afford a property that they're looking for.
Anybody have any questions so far?
Oh yeah, feel free to jump in anytime, guys. If you have any questions or any thoughts, I'll happily answer as we go. But yeah, those are a couple of cool caveats to the programs that we offer.
Okay. The other thing I'll add to your comment is in regards to the P&L program. The P&L program can also work for those borrowers that don't necessarily deposit all of their income. Let's say they get paid cash, they turn in an invoice, so it shows up as sales, but it does not show up on that bank statement.
That's a very good point. Yeah.
tool to help those borrowers.
Absolutely, those tip heavy, cash heavy
Okay.
borrowers, when they can show that they've had it, having somebody that can prepare that for them definitely helps. I appreciate you throwing that in there.
Yeah. So let's talk a little bit about those DSCR loans, how they work, and why they're popular.
Yeah, so DSCR loans are becoming more and more like, so they've been popular since I've been in the industry the last year or so. But from what I've learned talking with other brokers and seeing the deals happen, the bulk of my business is the DSCR space, and essentially it's just allowing the property to be cash flow and make you money while it also qualifies you to purchase that property. So debt service coverage ratio, right? They look at the DSCR, PITIA, principal, interest, taxes, homeowners association dues. They calculate all of the income for the property along with what you're collecting, and they look at that ratio, right? So they say you're collecting this much for rent, you pay this much for taxes, you pay for this much for insurance, your HOA costs X amount of dollars. That, and compared to what your mortgage is on it, determines the qualification of the property. And the good thing about the DSCR world is you get the best terms, of course, when the property is doing well, but there's also a path forward if the property isn't profitable, right? There's sometimes where you're in the process of trying to get your portfolio bigger, you're trying to grow your DSCR rate, you're trying to grow just your investment properties as an investor, and we can provide a path forward if the DSCR program, even if those properties aren't cash flowing. And then that gives them extra extra funds to do improvements, extra funds to then, do some cash outs on their properties and get some more improvements on the properties to then make more money with their rent later. But the DSCRs are popular because it doesn't look at you as a qualifying income person. It doesn't matter how much money you make. All we look at is your credit. So as long as you have a good credit score, and even with that, I closed on a DSCR where the borrower had a 602 FICO, and they were still able to purchase a DSCR property to then help them get their credit better. And I'm actually in the process now of closing a DSCR purchase for them a second time now that they've gotten their credit better, being able to get some more money from those DSCR transactions. But DSCR is a great world because it allows you to just base everything on the property. As a lender, we only care about the property as the asset, and that's how we qualify it. So it's a great way to have people start their investment world portfolios.
Okay. One comment wanted to give everybody, and a trick that sometimes you can flip to principal only to be able to meet. Let's say you need a 1% because of the FICO, because of this or because of that. You can always try and flip to interest only to make your property DSCR.
That's a great tip. Interest only loans go a long way when it comes to changing it because your initial payment, we'll base the ratio off of that initial interest only payment. So a lot of times that'll be a few $100s that they're saving in the calculation. So we offer options for 30-year, 40-year, 5 and 6 arms to do interest only as well. And we've had a number of deals that have come through where we've transitioned in the file to interest only because either the taxes came back a little bit higher than they thought, or they weren't able to get a lower insurance quote, and it threw the DSCR ratio for a loop. And a lot of times, to your point, that switching over to the interest only helps a lot.
But I will also caution unpermitted additions, unpermitted garages, ADUs. That can cause you headaches
Yeah,
depending
the
on what the
appraisal
appraiser says.
the appraisers are the kings. When they if the appraised value of the property is a big deal and how they look at it. A lot of times people try to do renovations on their property that weren't licensed correctly, and the appraiser won't give them the credit that they're looking for. So there's a lot of things to keep in mind, especially for those clients out there that are doing multiple DSCR properties and they have multiple investment properties. While you're doing these improvements and while you're doing things on the property, it's important to always consider how they're going to be appraised because at the end of the day, as a lender, we can only look at that appraisal. And if they're not willing to say what you're hoping that it would say, or something was done and there was another room created that wasn't done the right way, a lot of times it makes files become pretty messy.
So I really recommend you guys, as you're going through a lot of these, your your AE Luis is your pre-underwrite. If you already know there's
Absolutely.
this little bit of an issue, there's a little bit of a concern, your AEs in this non QM world are the first first person you guys should talk to. Don't be scared to bring up these issues ahead of time rather than going through a whole loan just to find out after you paid for an $800 appraisal that it's not going to work.
Yeah, that's it. So a lot of times, broker partners that I have, once we get files in, they'll order the appraisal beforehand. So I have files that get submitted and they have the appraisal ready so that they can kind of have a better picture of it. But before they do so, it is important to talk about the nuances to each property, and to talk about what unique traits those properties have to see how a lender will view them. But we at least at ACRA, one of the cool parts about what we do is we'll accept transfer appraisals, so we don't require them to be ordered in our name. So as the broker and as our partner, you can order the appraisal ahead of time. So when the file gets submitted, it comes in with an appraisal. It's ready to be vetted. It's ready to be looked at, and it makes files flow so much faster. Opposed to your owner occupied world where you need to wait to get your CDs signed and things like that, before you order appraisals. Having the ability to transfer in the appraisal and get it ordered early is super helpful on these transactions.
Awesome. Thank you, Luis. The other portion we want to talk about is a little bit of credit flexibility. How does ACRA look at credit differently than traditional lenders, and what kind of challenges can you work around?
Yeah, absolutely. So when it comes to credit events, there's a few nuances that we have that are very helpful. So one being if so we do all types of borrower types. We do, of course, U.S. citizens, permanent residents, non-permanent residents. We do ITINs. We have foreign nationals as well. So we qualify all types of citizenship types. Sometimes with non-permanent residents and ITIN challenges is credit depth, right? They might not have enough trade lines or they don't have enough for a amount of time. One of the things at ACRA that we do is if you can show me three scores on your credit report, it doesn't matter how much depth you have on that credit report. A lot of other lenders will require you to have so many trade lines to support the three scores. But if you can generate three scores, we'll take that, and it doesn't matter how much depth you have. So that's one thing that's really nice. Traditionally, if you have a bankruptcy that you've had to go through, we only require that that bankruptcy is 1 year removed, whereas other lenders maybe three, maybe five, maybe seven, based on how traditional you're getting. So we only require that they're 1 year removed, and then we also can support 60-day lates in a year on a mortgage, right? So we look at mortgage lates. We can support a 1 by 30. We can support 1 by 60. As long as they don't have any 90-day lates on their mortgage, we can find a path forward to get them a loan, even if they've had some issues with mortgage lates. I've had situations where it was automatic payments that were switched over from one lender to the other, and the client didn't realize that their loan was bought by another bank, and they ended up missing a payment because they didn't have their ACH form updated with that new lender, and it led to them having a mortgage late, and they weren't able to do a refi traditionally because of it. So I've had situations like that. Um, so yeah, a lot of times when it comes to credit events, if you have any type of mortgage lates, any type of foreclosures, any type of bankruptcies, we don't require as strict of guidelines with those as traditional lenders do.
Awesome. Awesome. Any other questions, team?
Yeah, please. If you guys have any thoughts or questions, or if you've come across something tricky that you weren't able to do, please throw it out there. I'd love a chance to talk about it.
Okay. So this is a conversation that I want to have with the team, but also get your perspective,
Yeah,
Luis.
please.
So when should a realtor pick up the phone and call me about a client instead of assuming they don't qualify? What are those scenarios
Oh,
that people tell you, oh wow, I didn't even know this would work?
so I tell my broker partners all the time, if you ever have to say no, call me first, right? And I tell real estate, I would assume the same for real estate agents when it comes to the partnerships they have with you guys as their brokers and loan officers. Is if if anything is outside of the box, whatever it is. I don't even think there's a situation. I don't think you should ever say no to a loan before you consult with a broker who has access to a bunch of lenders or a lender that specializes in oddly nuanced loans. If you ever have to say no, make a phone call because it's that simple, right? And I think it goes to all those pieces, right? Like there's a lot of lenders that, like a lot of LOs I've worked with that didn't know about the no ratio DSCRs, where it doesn't have to be bringing in money for it to work and to be qualified. There's a lot of them that had no idea about those credit event options that we had as well. Um, Even when it comes to like structuring a loan that's in the investment world or a business purpose loan under an LLC and the options that you have to close in an LLC and how you can utilize members of an LLC to better offer you terms on the loan. But for real estate agents and for loan officers out there that come across scenarios that slide on their desk and they're not pretty, reach out to a loan officer like the team here that has access to a lot of lenders and know the guidelines and have people they can reach out to, because there are so many paths forward that people don't even realize, and there's just money being left on the table on your side, but also there's people that are waiting to buy properties that don't have to be waiting. And we're hoping that the market gets better all the time, but we've seen markets go up, markets go down. If you have clients that are eager to get a property in their name, please do your due diligence to at least reach out to your loan officers that have multiple lenders in their pocket so that they can reach out to AEs like me and find that path forward, because there really is a lot of options that people just don't have any idea about. Even when it comes to, like you said, people that are cash heavy and they need another type of a bank statement loan that they can do. If I can tell you, if I can give you an option to just write your employment and accept that as employment, and you don't have to give me all the other documentation, and that's what's holding you back, then it's definitely an avenue that people need to find. While 85% of my business is bank statement and DSCR space, I have 13 other programs that are at your disposal if the situation fits. So for real estate agents and loan officers out there, before you say no, make a phone call, because there's a lot of options out here that people don't really know about. I've talked to loan officers that have been in the business for 25 years and have never done a non-QM loan, and they didn't even know that they were an option for them to do. And luckily for those loan officers to have enough business in the conventional space or the VA space or the reverse mortgage space or whatever it may be that they specialize in, money is being left on the table and people are not able to get into properties they want to get into because it's just an unknown space that is growing. So to your point, before you say no to a client, please reach out to your loan officers, and loan officers, before you say no to something that you can't close either in-house or with the lender that you're used to, reach out to somebody like me that specializes in non-QM, and you'll be surprised at how many paths forward you can find.
Any questions, team? Sure, Luis, because nobody else wants to say anything. Okay.
We good.
No, hey, I like giving you guys knowledge. I like having the
Call
conversation.
you
I do
Luis if I
appreciate the
need.
time. Yeah, no, absolutely. You guys have
Okay.
my number. I've reached out to all of you. Call me anytime. And I appreciate the relationship. The one piece I think is
But
important is having these relationships, right? So that you can have somebody to rely on in those tricky situations and bring those scenarios too. So I appreciate you guys very much.
one last question, Luis,
Yeah.
just so we can end this. Where do you see the biggest opportunity in the market right now for realtors to use non-QM loans to close more deals?
Honestly, to me, the easiest path, of least resistance, is the DSCR space. Get into business with people that are doing investment properties. Get into business that are people that are trying to build portfolios. And I feel like the DSCR space is just such an easy one to tap into. And for people that are in the real estate space that are around people that are talking about purchasing all the time, I feel like growing portfolios is a nice way to do it. And with the market changing the way it's been recently, anybody that you guys have done business with that has bought a property on either the owner occupied or the investment side in the last 3 years, I would strongly consider looking at those for refis with the way the rates have moved recently. I know for us with highly qualified borrowers in both sides, we got a platinum program that's going to get you a rate that's in the low sixes, which a lot of people came in 3 years ago and they were at the eights. So I think it's important to tap into that with how the market has moved lately as well, to just kind of get the business rolling. Hey, Kevin, how's it going, buddy? Good to see you, dude. But yeah, so I
Hey,
would say tap into the business you've done in the last 5 years and start getting them some better rates. I think that's a nice way. And then as you do that, right, if I can do a cash out and then I can use that money to get myself another investment property, I think it's a great avenue.
I think one of the most untapped resources we could do to create bank statement, or I'm sorry, DSCR loans is our cash outs,
Yeah, yep.
our
Get a
bank
cash
statement
out.
seconds, our P&L
Yep,
seconds, the DSCR seconds, all those kind of loans to get some money out of their equity so they can
yep.
buy investment properties. A lot of people think that, well, their business didn't do as well, this didn't do as well, that they can't buy investment properties. So I think calling all that database with those 3%, and you're not offering to refinance those. It's to get that 100, 200K out of there and see if we can create one more transaction, one more deal. Yesterday, I sat with a guy who had his house paid off, and he's sitting there. He's like, well, maybe I don't qualify for this, and I don't qualify for that. And the conversation I had with him is, hey, let's take some equity out of that investment property.
Yep.
And let's turn
That's
it
the way to sell
into
it.
bigger down payments so you can get a bigger primary, because he has zero
Absolutely.
debt. So when you're doing your ratios, even for a conventional loan, when you don't have a debt, all you're canceling out is your PI, or your TI, taxes and insurance. So if
Yeah,
you go and
exactly.
throw a debt on that, you can cancel that debt out. Now you have a bigger down payment. Bigger down payment means lower payment means higher qualification. So these are the type of strategies you can use. And I think in this world, you could either do it to buy primaries, to create, first investments, second investments, all that kind of stuff. So
100%. I agree completely. It's a great time to tap into those previous clients that you guys have had and get them to either get a better rate if they came in high, or to use some of that equity to then grow their portfolio and start getting some residual income on those properties.
so with that, Luis, do you have any questions for us?
I mean, my biggest question to you guys is when it comes to, because you have multiple lenders in your pocket and multiple different avenues that you can go out to. So what is it that you guys value the most from those relationships that lead you to sending them your business? It's like where do you find the most value in your AEs?
You want to single anyone out, or you want me to answer?
You can answer if anybody else wants to jump in. I mean, I'm open to it all. And one of the things that I try to do is control the pieces that I can, and I feel like the best piece that I can control is my service, my transparency, my communication. So I like to hear from you guys as far as what it is that is the biggest value when it comes to where you broker out your deals. Because I know some people are always rate sensitive, or some people are always timeline, or some people are always the relation. Like, what is it that you guys value the most from somebody in my position?
I think ease of use is one. So like ease
Okay.
from beginning of transaction to end, because we might only be doing one DSCR loan every 2 months, 3 months. So
Yeah.
if every single time it's a battle, that makes it tough. The other thing is the AE matters so much, because they give you all the answers to the test beforehand, so that you're not wasting your time trying to do a deal that isn't able to be done.
Yeah. Okay. I appreciate that piece. And like I said, I appreciate you guys taking the time very much. I don't have too many questions as far as that goes, but um, having you guys take the time out of your schedule to learn a little bit more and have a little Q&A means a lot to me. It helps me with my verbiage, helps me with my experiences, and just kind of helps me tighten up the tools as I get rolling. So I appreciate you guys.
Well, thank you very much. If nobody else has no other questions, I think we're done.